Imagine a vault with no walls. Your wealth shielded by global laws, not fireproof doors. In the world of offshore banking, savvy individuals and businesses harness international jurisdictions to ensure their assets thrive in peace, privacy, and full legal compliance. This guide will walk you through the exact structures, substance rules, and real-world tales that transform offshore banking from whispered legend into an ironclad financial strategy. Chapter 1. Behind the Vault. The true purpose of offshore banking. You've heard the rumors. Offshore banking is either a secret playground for the ultra-rich or a legal minefield waiting to explode. Let me cut through the noise. Offshore banking, when done right, is simply a tool that empowers you to protect, organize, and grow your money under clear, enforceable rules. In this chapter, we'll strip away the jargon and focus on exactly why you might choose an offshore account, and how to get started without tripping over hidden costs, compliance headaches, or dodgy operators. First, asset protection isn't about hiding money from legitimate authorities. It's about insulating your wealth from local risks. Imagine you run a small business in a country prone to political upheaval. A local court judgment or abrupt tax hike can wipe out your life's work overnight. By placing certain assets in a jurisdiction with strong legal firewalls, say Singapore or Switzerland, you're not evading taxes, you're shielding your capital from unpredictable changes at home. Actionable tip. Before you sign with any bank, ask for a copy of its governing law and confirm that disputes are handled in an independent arbitration center, not your own local courts. Second, liquidity management means having access to cash when you need it, without surprise freezes or draconian withdrawal limits. Believe it or not, some domestic banks can hold withdrawals for weeks during a crisis. Offshore banks catering to international clients often advertise a clear schedule, same-day wire transfers, online platforms with 24/7 access, and backup lines in multiple currencies. Actionable tip. Test the system yourself. Deposit a small sum, request a withdrawal at an odd hour, and measure exactly how long it takes. If you get stuck on hold more than 3 minutes, consider another provider. Third, diversification spreads risk across geographies, currencies, and financial systems. Holding everything in your home country ties you to one economy. Offshore banking lets you allocate portions of your portfolio, cash, bonds, even fruit-bearing dividend stocks, in jurisdictions that complement each other. Want exposure to Eurozone yields? A Malta-based money market fund could fit. Need US dollar stability? A Cayman Islands registered trust might be ideal. Actionable tip. Draw a simple chart listing 3 categories: capital preservation, income generation, growth, and assign each to a different region. That way, you avoid the all eggs in one basket trap. Now, let's translate these concepts into 3 no-nonsense rules. Define your goal in 1 sentence. Are you protecting business proceeds from lawsuit risk? Are you seeking faster access to multiple currencies? Write it down. If you can't state your objective in 1 sentence, you'll chase shiny features instead of solving real problems. Pick a jurisdiction that matches your goal. Once your goal is clear, map it to a jurisdiction's strengths. Political stability? Look to Switzerland or Singapore. Low-cost fintech access? Consider Malta or Cyprus. Substance requirements matter, meaning the jurisdiction demands you maintain a real office and local staff. That's good. It proves to regulators you're serious. Actionable tip. When speaking with a service provider, ask for their recent economic substance certificate and verify the date and issuing authority. Validate the provider's credentials. Offshore banks and corporate service firms must be licensed by local regulators. Don't rely on slick websites. Request a scanned copy of their license, then cross-check the license number on the regulator's online register. If the regulator's site is down or in a language you don't understand, hire a local lawyer for a 1-hour compliance check. Next, let's walk through a simplified setup process in 5 steps. Get organized. Pull together basic documents: passport, proof of address, and a 1-page statement of purpose, your sentence from Rule 1. Reach out to 2 providers. Compare fees, onboarding checklists, and turnaround times. Agreement should arrive within 5 business days. Submit paperwork and pay fees. Don't overpay. Ask for a fee schedule showing annual renewals, transaction limits, and extra charges for currency conversion. Verify your account. After approval, fund with a test deposit. Confirm you can view balances and initiate transfers through your chosen portal. Schedule annual check-ins. Set a calendar reminder to review compliance requirements, new substance rules, changing tax reporting standards, or updated KYC policies. Throughout this process, two pitfalls loom largest: hidden fees and outdated service providers. Hidden fees creep in as maintenance charges or correspondent bank surcharges. Always demand a full fee breakdown before you transfer a single dollar. Outdated providers may cling to old substance rules that no longer satisfy the OECD or EU, so their clients get flagged. Verify that any provider you pick demonstrates up-to-date compliance certificates. By following these steps, you transform offshore banking from a shadowy concept into a straightforward, rule-bound solution. You'll know exactly why you're opening the account, which jurisdiction fits, and how to keep it in good standing. In the next chapter, we'll deep dive into the top offshore hubs and compare them side by side, so you can pick your fortress wisely. Chapter 2. Jurisdiction Deep Dive. Choosing your stronghold. You're standing at a crossroads. You need to park your assets in a safe harbor, but you don't know which port to sail into. First, forget the old headlines about secret vaults and hidden ledgers. Today's offshore powerhouses compete on stability, transparency, and rock-solid compliance. Your mission is to match your goals, fundraising, cash parking, estate planning, to a jurisdiction that checks the boxes for substance requirements, local licensing, banking access, and cost. Get this right up front, and you avoid red flag audits, frozen accounts, and sky-high compliance fees down the road. Let's start with the Cayman Islands. If you're setting up a fund or a partnership, Cayman is still the gold standard. Actionable rule: engage a licensed corporate service provider listed on the Cayman Islands Monetary Authority website. Expect to pay roughly $500,000 per year for a registered office, plus a single nominee director to satisfy substance rules. Budget another $10,000 annually for minimal local staff or outsourced administration. Tip: schedule at least 2 board meetings on Cayman shores, even if virtual, so you can burn meeting minutes and prove economic activity. With those steps, you'll sail past regulator scrutiny and secure bank accounts with prime international banks. Next, consider Singapore, Asia's fortress of compliance. Here you form a private limited company with an authorized capital of 50,000 Singapore dollars. Practical step: lease a virtual office for around 2,000 Singapore dollars per year and appoint one resident director through a licensed trust company that satisfies the Singapore Economic Development Board's substance test. Open your corporate bank account at DBS or OCBC. You'll need at least 30,000 Singapore dollars on deposit to avoid fees. Pro tip: keep your board minutes and accounting records in country. Do that, and you'll tap into Singapore's premier fintech ecosystem and top-tier banking without breaking a sweat. Switzerland remains synonymous with stability, but it comes at a price. To qualify as a Swiss resident entity, you need either a local paying agent or one executive director living in Switzerland. Annual fees start at 5,000 Swiss francs for administration, plus a minimum bank balance of 250,000 Swiss francs if you want private bank services. If your plan is custody of securities or cash management, this makes sense. Actionable tip: verify your fiduciary partner's license on the Federal Register of Commerce and insist on quarterly on-site reviews. That way, when FINMA comes knocking for proof of substance, you'll hand over polished compliance reports. No scrambling required. For businesses eyeing the European Union, Malta and Cyprus both deliver cost-effective pathways. In Malta, incorporate a private limited company with €1,165 share capital, at least 20% paid up. Rent a small office, €1,200 yearly, and hire or appoint one local employee or director nominee for substance compliance. Your annual return and audited financials are due by September 30th, so mark that in your calendar. Cyprus offers an even lower €1,000 minimum share capital requirement and one local director, plus a 12.5% corporate tax rate. Actionable tip: leverage Cyprus for holding company structures. Dividend distributions between EU parent and subsidiary are tax-exempt if you maintain a 50% shareholding and real staff on the ground. Now let's boil it down to 4 simple, no-nonsense rules for cutting through the noise. Verify licensing before you sign. Always check your corporate service provider's name against the local registry or regulator's website. If they aren't listed, walk away. Map your substance in bullet points. List what real presence means in each place. Office square footage, minimum staff headcount, bank balance, board meeting frequency. Build that into your first-year budget. Crunch total cost of ownership. Add up registration fees, annual license renewals, office rent, director fees, and banking minimums. If it totals more than 2% of your assets under management, switch jurisdictions. Monitor regulatory news weekly. Set a Google alert for economic substance, plus your jurisdiction name. If you see words like amendment, audit, or penalty, tag your advisor and update your substance plan immediately. Skip these steps, and you risk waking up to a frozen bank account, a regulator's cease and desist order, or a multi-million-dollar back tax bill. But nail them, and you transform a bewildering maze into a clear blueprint you can implement in under 30 days. By matching your specific needs, whether you're running a hedge fund in the Caymans, a trading arm in Singapore, a custody vehicle in Switzerland, or an EU holding company in Malta or Cyprus, you'll secure a jurisdictional stronghold that works like clockwork, not a risky game of hide and seek. Follow the rules, keep your records tight, and your offshore strategy will withstand any compliance storm. Offshore banking, done right, is not about hiding money. It's about smart, lawful financial planning that leverages international laws. But here's the catch. The days of setting up a mailbox in the Caribbean and calling it a day are long gone. To succeed in today's regulatory environment, you need a solid understanding of compliance and substance requirements. Let me break this down for you. First, let's talk about why compliance matters. Offshore jurisdictions used to have a reputation for secrecy. Think numbered accounts and no questions asked policies. That era is over. International frameworks like the OECD's Base Erosion and Profit Shifting (BPS) initiative and the Common Reporting Standard (CRS) have reshaped the landscape. Banks and governments now exchange information, and the focus is on transparency. If you're not compliant, you're risking fines, frozen accounts, or worse, a knock on your door from tax authorities. So, what does compliance actually mean for you? Let's start with substance requirements. This is a game changer. Most reputable offshore jurisdictions now require businesses to prove they're more than just a shell. In simple terms, you need to show that your offshore entity has a real, operational presence in the country where it's registered. This means having a physical office, a real address, not a virtual one. This could be a small space in a co-working facility or a full-fledged office, depending on the scale of your operation. Local staff, employees who work and live in the jurisdiction. You don't need a big team, but you do need people who handle day-to-day business activities. Management decisions made locally. This is crucial. Key decisions about the business must be made within the jurisdiction. That means holding board meetings there and documenting them properly. Now, let's get into the practical side. How do you actually make this work? Here's some actionable tips. Choose the right jurisdiction for your needs. If you're looking to trade globally, Singapore might be your best bet because of its strong infrastructure and banking system. If you're setting up an investment fund, the Cayman Islands could be ideal due to its streamlined regulations. Don't just pick a jurisdiction because it's popular. Match it to your business goals. Work with a reputable service provider. Don't try to set up an offshore entity on your own. Partner with a corporate services firm that has a strong reputation in your chosen jurisdiction. They'll help you navigate local rules, find office space, hire staff, and ensure you're meeting substance requirements. Think of them as your local partner. Invest in good record keeping. Compliance isn't just about setting things up correctly. You need to keep proving it. Maintain detailed records of all your operations, from financial transactions to board meeting minutes. Use a cloud-based system to organize these documents so they're easy to access and update. Here's a real-life example of why this matters. A small tech company wanted to expand its global reach and decided to set up an offshore entity in the British Virgin Islands. They hired a corporate service provider to handle the process. The provider secured a physical office, hired a part-time local administrator, and helped the company's board members fly in twice a year for meetings. Everything was documented, and when the BVI's regulatory authorities audited the entity, it passed with flying colors. On the flip side, there's a cautionary tale. A family office decided to set up a holding company in Vanuatu. They cut corners, using a P.O. box as their address and hiring a nominee director who lived halfway across the world. When Vanuatu tightened its compliance laws, the company failed to meet substance requirements. Their accounts were frozen, and they spent months and tens of thousands of dollars trying to fix the mess. The lesson? Shortcuts are expensive. Chapter 4. Corporate Structures, Trusts, Foundations, and IBCs. In this chapter, we dive into 3 essential building blocks for offshore planning: the International Business Company, IBC, the Offshore Trust, and the Private Foundation. Think of these as specialized tools in your financial toolbox. Each delivers a unique blend of asset protection, privacy, and flexibility. IBCs act like offshore LLCs that can hold property, open bank accounts, and sign contracts. Trusts transfer legal title to a trustee for beneficiary benefit. Foundations combine company-style governance with trust-style confidentiality. Rule 1. Use an IBC when you need a straightforward corporate vehicle that acts like an onshore LLC but with offshore benefits. It's ideal for holding shares, real estate, or trading internationally. Actionable tip: pick a jurisdiction like the BVI or Seychelles with no minimum capital, simple online incorporation, and modest fees. File your articles of incorporation, register your company name, and pay the registration fee. Once approved, open a bank account in the IBC's name with a copy of your incorporation documents. Substance matters. Regulators frown on empty shells. Treat your IBC as a real business. First, appoint a local nominee director or use a licensed service provider with onshore staff. Second, lease a small office or co-working space with actual employees. Third, hold and record at least 1 annual board meeting with minutes. Finally, keep a local bank account with a small operating balance to show genuine banking activity. Rule 2. Turn to an offshore trust when you want an extra layer of separation between ownership and benefit. A trust is simply a legal promise. You transfer title of assets to a trustee who holds them for beneficiaries according to your instructions. This is perfect for estate planning, protecting family wealth from lawsuits, or managing intergenerational handoffs. Popular trust-friendly jurisdictions include the Cayman Islands, Jersey, and Guernsey, where trust laws are clear and trustees must be licensed and regulated. In a discretionary trust, beneficiaries don't own fixed shares. This discretionary power cushions against divorce claims or creditor attacks. Without tight trust deed drafting, however, vague instructions can lead to disputes or frozen assets, so clarity is key. Picking the right trustee is non-negotiable. Always select a regulated trust company with onshore staff and strong AML/KYC controls. Actionable tip: verify licensing, meet your trust officer, and ask for compliance certificates. In your trust deed, demand clear definitions of beneficiaries, precise distribution triggers, like age or education, and explicit trustee powers. Include a letter of wishes to guide discretionary payouts. Finally, schedule an annual review to confirm tax filings and adherence to your goals. Rule 3. Use a private foundation when you prefer a company-style setup with trust-style privacy. Think of a foundation as a mini corporation. It has its own legal personality, statutes, and a council that governs based on bylaws. Ideal for family governance, charitable projects, or holding company shares safely. Foundations don't list beneficiaries publicly. They distribute to purpose or class of individuals. Top jurisdictions include Liechtenstein, Panama, and Malta, each requiring a local registered office, council members, and an appointed protector if desired. Be aware that some jurisdictions require a minimum capital deposit, often $1,000 to $5,000, to demonstrate economic purpose. To build a bulletproof foundation, start with detailed statutes. Clearly define council member roles, appointment and removal procedures, voting thresholds, and asset lockup rules. Next, work with a seasoned foundation service provider who will handle registration, maintain the official register, and file annual financial statements. Actionable hack. Include a simple investment policy clause. This shows genuine economic purpose and satisfies substance requirements. Don't forget to set your initial capital. Open a local bank account in the foundation's name. Conduct quarterly council meetings with recorded minutes, and store original statutes and minutes in a secure vault. Picking between an IBC, trust, and foundation boils down to control, confidentiality, and cost. Ask yourself, do you need direct corporate authority? Then the IBC wins. Prefer fiduciary oversight? Lean on a trust. Want a hybrid right out of the box? A foundation fits the bill. In practice, savvy planners layer these vehicles. An IBC owns operating assets, sits beneath a discretionary trust, which in turn may sit under a family foundation. This stacking strategy maximizes protection at each level, but beware of over-engineering. Each layer adds fees, administrative duties, and reporting obligations. Also weigh the cumulative cost and reporting load. Too many layers can trigger red flags and unnecessary fees. By adhering to these 3 core rules, structure your IBC with tangible substance. Appoint a licensed trustee with a watertight deed, and draft foundation statutes that prove real purpose. You'll design offshore setups that regulators respect and adversaries can't penetrate. These actionable steps transform complex legal concepts into a step-by-step blueprint you can implement today. By mastering these legal foundations and compliance essentials, you'll transform your offshore structure from a regulatory liability into a fortress. You'll avoid surprise audits, maintain clean reputations with banks and regulators, preserve your banking relationships across jurisdictions, and sleep soundly knowing you've ticked every box. Follow each rule precisely and maintain vigilance. And the only thing you'll wield is peace of mind, knowing your assets are shielded by ironclad legality. You've built your offshore structure, but now it's time to meet the watchdogs. In today's financial world, trust is earned by transparency, not secrecy. If you miss a single reporting deadline or file the wrong form, you'll face heavy fines, frozen accounts, or worse. In this chapter, you're about to learn simple, step-by-step rules to master the common reporting standard in FATCA. Keep your bookkeeping bulletproof and sleep easy at night. First, never underestimate the power of a clean self-certification. The Common Reporting Standard, or CRS, is a global information exchange mechanism. It's not optional. Action rule. Collect a valid CRS self-certification form from every new account holder, trust beneficiary, or corporate director. Use a standardized template from your service provider. Store signed PDFs in a timestamp folder named SARS_certs_OY so you can locate them in under 10 seconds. If you onboard 10 clients, you must collect 10 forms, no exceptions. Second, create a report calendar that flags 2 key dates: your home jurisdiction's CRS filing deadline and your bank's cutoff date for data submission. For example, if your bank sends you data on July 31st and your local filing deadline is September 30th, you need to finalize your data no later than August 15th. Action rule. Set recurring reminders in your calendar app. 1 for data collection, 30 days before cutoff, and 1 for final review, 15 days before deadline. Stick to these reminders like clockwork. Third, standardize your data intake. Whether it's Excel, CSV exports from an online portal, or manual ledgers, convert everything into one template with columns for name, tax ID, country of residence, and account balance. Action rule. Use a simple spreadsheet with protected cells. Lock headers and formulas so no one accidentally overwrites your VLOOKUP or pivot settings. Run a weekly check to catch missing fields. Nothing worse than a blank country when you're about to file. Next, tackle FATCA head-on if you have any U.S. connections. FATCA requires foreign financial institutions to report U.S. persons' accounts to the IRS. Action Rule: register for your Global Intermediary Identification Number, GIN, on the IRS website within 30 days of opening your first U.S.-connected account. Then, file Form 8966 by March 31st, non-electronic filers, or June 30th, electronic filers. Mark these dates clearly on your calendar and assign one team member as FATCA officer to own the process end-to-end. Fifth, don't rely on memory or sticky notes. Document every step in a single compliance playbook PDF. Section 1. How to collect CRS and FATCA certifications. Section 2. Data templates with sample entries. Section 3. Contact details for your primary bank relationship manager, local counsel, and external audit partner. Update this playbook annually. Print a hard copy, keep a digital version in your encrypted vault, and confirm its existence with your service provider each January. Beyond CRS and FATCA, be aware of beneficial ownership registers in your chosen jurisdiction. Many Caribbean and European jurisdictions now require you to declare ultimate beneficial owners, UBOs, publicly or to a government portal. Action Rule: by year-end, log into your registry portal, cross-check names against your internal cap table, and confirm no new UBO changes have occurred. If a director changed in June, update the registry by December 31st to avoid penalties. To streamline all of this, invest in a basic compliance dashboard, either as part of your banking portal or via an independent fintech. Action Rule: choose a provider that supports automated data feeds. Swift MT940 or API flags anomalies, missing ID numbers, mismatch balances, and issues a monthly compliance health check report. Budget for this tool as an operating expense. It pays for itself by preventing multi-month investigations. Let's apply these rules to a real-life scenario. Imagine you're managing an international trading company in Singapore. You've got 10 shareholders, 2 trusts in the Caymans, and a private equity fund in Switzerland. In July, your bank sends you account data. You immediately run your data through your spreadsheet template, spot one shareholder missing their tax ID, send an automated reminder, and collect the form within 3 days. You file CRS by September 30th with 0 revisions. Because you stayed on top of Form 8960 SXS March 31st deadline last year, you never faced IRS penalties. That's how following clear, actionable rules keeps everything smooth. Finally, schedule an annual self-audit. Pick a quiet month, January works well, and walk through your compliance playbook line by line. Confirm that your report calendar entries still align with current deadlines. The data templates match any new bank requirements, and your registry filings reflect actual ownership. If you spot outdated contact info or missing forms, fix them immediately. No, I'll do it next month. Do it now. By following these straightforward, rule-based steps, collect certifications promptly, lock down your data template, automate reminders, register for your GIN, update your UBO registry, invest in a dashboard, and self-audit annually. You transform reporting from a headache into a seamless process. You'll stay compliant, avoid fines, and ensure your offshore structure remains rock solid in the eyes of regulators. Chapter 6. A Success Story in the Cayman Islands. When Sarah Chun, a successful tech entrepreneur, decided to launch her first offshore private equity fund, she faced a maze of rules, high fees, and skepticism. Today, her Cayman-registered vehicle manages over $120 million in assets with spotless compliance and 0 back tax liabilities. Here's exactly how she did it, and how you can replicate her success in 4 simple, non-negotiable steps that turn complex regulations into clear, actionable moves. Sarah started by selecting her on-the-ground team. Rule 1. Always work with a fully licensed Cayman Islands based fund administrator and law firm. She interviewed 3 firms, checked regulatory registers, and asked each for 3 client referrals. Within 2 weeks, she chose a provider with a track record of at least 5 five-star audits and no enforcement actions in the past decade. That one decision cut her regulatory risk in half instantly and gave her a partner who handled everything from board minutes to compliance filings. Next, she tackled substance requirements head-on. In 2023, Cayman introduced strict economic activity standards. You must prove real operations, not just a P.O. box. Sarah rented a modest office, 1,000 square feet in Grand Cayman, hired 2 full-time local staff, a compliance officer and an office manager, and held quarterly board meetings on the island. Rule 2. Document every lease agreement, payroll run, and meeting agenda. At tax time, her auditor flagged no issues because every line item in her books matched a genuine Cayman expense. Then came reporting. The Common Reporting Standard, CRS, and FATCA demand ironclad transparency. Banks now exchange client data with 100-plus countries. Rule 3. Automate your reporting calendar. Sarah's administrator set up calendar alerts for all deadlines, annual return, audit submission, beneficial owner updates, and integrated her fund's accounting software to generate client-level reports with one click. When the Cayman Tax Information Authority logged in, they saw an organized portal with every document clearly named and time-stamped. No surprises, no extensions, no penalties. Maintenance might sound boring, but every dollar saved here goes straight to your bottom line. Sarah budgeted $75,000 per year for service fees, split evenly between administration, legal updates, and audit costs. Rule 4. Review your fee schedule every January. She compares invoices against a benchmark she tracks in a simple spreadsheet, line by line, service by service, so she never pays more than market rate. In 2024, that review saved her $12,000 when she switched to a new auditor offering equivalent standards for 15% less. By the time Sarah opened her fund to investors, she had a clear story. My Cayman fund isn't a secretive shell. It's a fully staffed, fully compliant vehicle built for long-term growth and zero surprises. That narrative attracted family offices and institutional LPs who wanted reassurance, not offshore mystery. Within 3 months, she closed her first $50 million tranche, and within 9 months hit her $120 million target. Her investors knew exactly where their paperwork lived, who was in the office, and that every compliance box was checked. Sarah's success comes down to precision. Pick proven partners, meet COV, erase rules with real activities, automate every deadline, and keep a ruthless eye on fees. If you're planning your own Cayman fund or any offshore structure, follow her blueprint. Rent a workspace, hire local experts, schedule your compliance calendar now, and audit your invoices every year. Do that, and you'll turn offshore banking from whispered rumor into a concrete, well-oiled engine for asset protection and growth. Chapter 7. When Good Intentions Go Awry. Picture this. A family office set up in Vanuatu, promises of privacy and tax savings dancing in everyone's heads. They rushed through the online sign-up, paid a flat fee for company formation, and thought the job was done. Fast forward 6 months, and their bank account is frozen, regulators are knocking, and legal fees are piling up, all because they ignored the simplest rules for substance and compliance. They believed that registering an address on a virtual mailbox would satisfy real presence. It didn't. Rule 1. If your offshore jurisdiction requires substance, you need tangible proof, an actual office, real staff, genuine local executives. In practical terms, that means leasing a workspace, hiring at least 1 employee on the books, and holding quarterly face-to-face or video conference board meetings where minutes are taken and signed. No exceptions. Treat these meetings as sacred calendar events. Miss one, and it triggers red flags. Cost was their second excuse. It's too expensive to maintain an office in Vanuatu, they complained. True, it adds fees. But tip 2, budget for substance from day one. Think of it as insurance. A small expense compared to the cost of frozen assets or protracted investigations. Shop around for service providers. Don't pick the cheapest outlier. Ask for references from clients in similar industries. Schedule a virtual tour of the proposed office. If they won't show you a real desk or introduce you to a local manager, walk away. Next mistake, sloppy governance. They set up the company, but they never drafted clear bylaws or governance policies. No shareholder agreements, no audit committee, nothing to show how decisions were made. When regulators asked for a copy of the board resolutions approving wire transfers, they had no record. Actionable tip: adopt a simple governance template on day one. Decide who holds the power, how profits are distributed, and draft that into a 2-page document. Store signed copies in a secure digital vault and back them up in the cloud. This single step cuts the risk of paper trail audits in half. Their record keeping was equally haphazard. Invoices for consulting fees were missing bank stamps, contracts lacked signatures, and email chains were scattered across multiple inboxes. The auditors demanded proof of every dollar in and out. Pain point: no one wants to hunt through years of lost files. Rule 3. Within 48 hours of any transaction, update your central document repository. Scan, label, and tag every contract, invoice, and bank statement. Use a file naming convention like YYYYM, DD_ client name _ invoice 001. This small discipline saves days of headache when regulators come calling. They also underestimated the pace of regulatory change. Vanuatu quietly adopted new economic substance requirements 6 months after formation, but they never signed up for legal updates. Big mistake. Tip 4. Subscribe to at least 2 jurisdiction-specific regulatory newsletters and set up Google Alerts for terms like Vanuatu Substance Regulations or Cayman Islands AML Update. Once a quarter, review the alerts with your compliance officer and adjust your practices immediately. Ignorance is not a defense. When a local authority flagged their non-compliant structure, their funds were immobilized overnight. They scrambled to hire an expensive law firm, promised to retrofit substance, and begged for account reactivation. But by then, reputational damage was done. Their U.S. and European banking partners were on notice, and every future transaction triggered additional KYC, know your customer, hurdles. What began as an innocent cost-saving tactic turned into a years-long ordeal. So here's the bottom line, spoken in plain terms. Verify your service provider. Only work with firms that let you inspect the office, meet the manager, and see evidence of their other clients. Secure substance day one. Lease space, hire staff, hold board meetings. No virtual mailbox shortcuts. Calendar compliance events, quarterly meetings, annual audits, tax filings. Automate reminders and treat them as non-negotiable. Centralize your documents. Scan and store everything within 48 hours. Label consistently so you can find any file in seconds. Stay ahead of rule changes. Subscribe to regulatory alerts. Review them every quarter and adjust operations before deadlines hit. By following these steps, you avoid the freezing account nightmare and keep your offshore plan running smoothly. Good intentions won't cut it. Discipline and foresight will. Keep it simple, keep it documented, and you'll sleep easy knowing your assets are protected, not penalized. Chapter 8. Building your offshore blueprint. You're about to build an offshore plan that actually works. No jargon, no wishful thinking, just clear steps you can take right now. Rule number 1. Start with a sharp self-inventory. Grab a sheet of paper or open a simple spreadsheet and list every asset you own: investment accounts, business interests, real estate. Next to each entry, write down your top 2 goals. Is it tax efficiency, privacy, or international expansion? Finally, note one concern for each. Are you worried about changing laws, currency swings, or unwanted scrutiny? That single exercise turns a vague idea of, "I need offshore banking," into a targeted mission. Rule number 2. Match your profile to the right jurisdiction. Don't chase exotic names. Pick the place that fits your needs. If you're a tech entrepreneur looking for rock-solid compliance, Singapore's substance rules and digital infrastructure make it a smart choice. If you manage a private equity fund, The Cayman Islands' established service providers and zero tax regime cannot be beaten. Run a quick Google search for jurisdiction plus substance requirements and verify you can meet the 5 essential criteria: a local registered office, a resident director, genuine board meetings, bookkeeping onshore, and adequate paid-in capital. If any of those 5 trip you up, move on to the next jurisdiction on your list. Rule number 3. Nail down your entity structure before you talk to a bank. You'll typically choose between an international business company, IBC, a trust, or a foundation. Each serves a distinct purpose. Let's say you settle on an IBC in Singapore. Draft your articles of association with the help of a local law firm, register with the Accounting and Corporate Regulatory Authority, and order certified copies of your incorporation documents. At the same time, set up a multi-currency digital account with a bank like DBS or Standard Chartered's Breeze platform. Transfer your initial seed capital, often as little as $1,000, and record the transaction in your entity's ledger. That paper trail shows regulators and bankers you're serious about substance, not secrecy. Rule number 4. Build substance with everyday actions. It's not enough to pay for an empty office. Schedule a 30-minute video call every month with your resident director, keep digital minutes, and file annual returns on time. If you hire a local accountant for basic bookkeeping, you earn compliance brownie points. Use an entity management tool, Diligent Entities, or Entity Keeper, to set reminders for annual fees and document renewals. Automate at least 80% of your record keeping. E-invoices, bank statements, and director resolutions all live in a shared, encrypted folder. That's how you turn paperwork drudgery into a compliance moat. Rule number 5. Integrate fintech to streamline cross-border flows. Traditional banks move slowly. Fintech platforms can cut settlement times in half. Open an account with Wise Business or AirWallex to receive USD, Euro, GBP, and more, all under one roof. Test each incoming payment by wiring a small amount first. Then confirm the IBAN and SWIFT details match. Set daily limits that match your cash flow needs and authorize payments only from whitelist devices. Those 2 simple checks stop 90% of fraud attempts dead in their tracks. Rule number 6. Automate compliance reporting. The Common Reporting Standard, CRS, and FATCA aren't going away. Embrace them. Use a tax reporting tool like TaxJar or Avalara to generate your annual CRS self-certification forms. Link the tool directly to your bank account, so when your provider asks for an updated record, you upload it in under 5 minutes. If you hold U.S. clients or accounts, register for an FATCA Global Intermediary Identification Number and file your 8966 form by the March 31st deadline. Automating these steps cuts your tax team's workload by at least 60% and prevents nasty fines down the road. Rule number 7. Future-proof for emerging rules. Environmental, social, and governance, ESG, metrics are creeping into banking. Decide today how you'll measure the carbon footprint of your offshore investment portfolio, whether that means avoiding coal-heavy companies or choosing green bonds. For crypto assets, consolidate your wallets on TravelRule, compliant platforms, and run transaction reports through Chainalysis or Elliptic. Then subscribe to one authoritative regulator update service, like the International Bar Association's mailing list, and carve out 15 minutes each month to skim new developments. That tiny habit keeps you ahead of tomorrow's audit, not scrambling to retrofit compliance at the 11th hour. By following these 7 rules in sequence: profile, jurisdiction, structure, substance, fintech, automation, future-proofing, you create an offshore blueprint that lives up to its promise. No more whispered deals, no more guesswork. Just a clear, repeatable framework that protects your wealth, respects the law, and scales as you grow. That's your practical path to offshore peace of mind.